Good afternoon, everyone. How was lunch today? We try to surprise you a little bit every time with something a little bit different, and we had this for the other day. They catered for us, and we thought it was pretty good. So we'll do it again if you like it. Welcome to the 2014 LPL semi-annual market outlook. And if you came to our earlier class this year, we've kind of based it on the Farmer's Almanac, as you can see from the theme here. And I think a lot of people here probably maybe grew up on a farm or grew up in a farming community, or maybe had grandparents that had a farm. How many folks in here actually lived on a farm or were, yeah, so quite a few. I actually grew up in northern Minnesota, and it was more of a hobby farm, but I worked on different farms when I was growing up, and it's good life up there. So I thought I'd start off and talk a little bit about the Farmer's Almanac. I'll talk a little bit about what the outlook is for farmers, and then we'll talk about the outlook for the market, for the stock market. So that as far as the farmers, wheat drops. Here's the most recent headline. It says, "Wheat drops with corn on outlook for rising global crop supplies." So wheat slid to near the lowest level in 4 years on expectations that global production will climb to a record. Corn fell for a second year. The top grower, the U.S. as the top grower, is going to have its biggest harvest ever in corn. So actually, farm prices are falling right now. So if you hear farmers or you still know people in the farm community, prices are actually going down. And it's not necessarily due to the weather, it's just due to the abundant supply. And we're going to talk about that as one of our mega themes later today in the presentation. The other thing that's hurting the farmers right now, I don't know if you've seen these headlines in the Star Trib, rail shipping delays cost Minnesota corn, soybean, and wheat farmers nearly $100 million. So right now there's a lot of corn that's still in storage because they can't get the trains to ship their soybeans or wheat or whatever it is. And so the farmers are actually losing 40 to 60 cents per bushel, and that's really could make or break a farm as far as those profit margins are concerned. So why is there a bottleneck in the rail? Oil, yeah. And that's one of our other mega themes that we're going to discuss today. And you've seen these maps before from our other presentations, but I'll hand these around. You don't have to squint to see them. But this map here, do you remember these are all the oil and natural gas plays across the United States? And this all trend started 4 or 5 years ago with hydraulic fracking, horizontal drilling. And so there's a lot of oil and natural gas in play. And right now the United States is the #1 global producer of petroleum products and also crude oil. And I'll hand this chart around, but it shows the number of crude oil rigs. The crude oil rig here count in the United States. You can see it's like a hockey stick. It's just shot up tremendously. The U.S. are at their highest export level ever in history for crude oil. And right now, Texas produces more oil than the whole, or just Texas alone has more oil production than we import from the Persian Gulf area. So right now, the United States is becoming quite energy independent. And you could hand that chart around if you would, please. This is another interesting thing that ties into the rails. And you won't be able to see this map well from where you're at, but I'll hand it around. But this is a map in 2010, and you'll see on here that there's 6 loading facilities for rail transport, and there's actually 4 unloading facilities in the United States. So there's 6 and 4 down in these areas here. Now, let's fast forward to 2013. You guys see that? I can't even count the number of loading and unloading facilities. But that's in a 3-year period, so it's just grown tremendously. And this is another mega trend that we're going to talk about today. It's a good area for investors to be putting money for growth. So if you want to hand that around, Sheila, that'd be good.
So we import and export petroleum products?
I guess so, yeah.
Do you know why?
we had earlier this year, when you guys were probably down being snowbirds, we did a presentation on master limited partnerships and the flow of oil and natural gas. And he was talking about it's just a matter of where the refineries are located. So like if they have oil from the Bakken, it's difficult to get it to the East Coast refineries, so it's easier to import it. Transportation is a lot of the bottleneck right now. So a lot of the oil is being transported by the rail cars, and that's actually hurting the farmers because it's delaying, and so they're complaining a lot right now. So interesting stuff. So with that, and again, if you have questions as I go along, feel free to ask, and we'll try to address them. So talking about the markets won't take as long as it took me just to do the intro today, because the markets are doing so well, which is great news for everyone. So basically what we're looking at right now, kind of notes from the field as to what we're observing. The field notes are following right along with what we predicted in January. So 3 different areas, and you do have some handouts on these that will somewhat follow the slides. 3 gauges. The first one is 3% GDP growth. So we're right on track for that at this point in time. So you probably knew from first quarter of this year, the economy got off to kind of a slow start, a little bit they say due to the weather. But then second quarter of this year, the numbers came in at 4% growth rate, GDP growth rate, growth and expansion of our economy. So combined, we're on target very easily for 3% GDP growth, and that's good for everyone. And we'll talk about the driving sectors behind that. 10 to 15% growth on equities. We're more than halfway there for that mark right now. So that's also a good sign. So we're expecting low double-digit rates of return for stocks this year. And then the bond market, we're predicting flat returns on bonds. And so far, our economists have been wrong in this area. Bond returns have actually been pretty good so far this year. On average, bonds have gone up about 3.5%. And we think a little bit of that is due to last year, bonds were very flat, so this year was somewhat of a recovery year. And then also last year, there was a lot of talk about interest rates rising, so people sold their bonds, but now people bought their bonds back because rates might not go up until 2016. So all 3 of these gauges have been pretty spot on so far. Let's break it down a little bit. Let's talk about kind of where we're at with the seasons in the economy overall. And so basically, we're not in an early recovery stage. We've been through that after 2008 recession. A lot of jobs lost. A lot of those jobs were adding about 200,000 new jobs per month, and unemployment rate is 6% or so across the nation, which isn't nearly as high as it. I think it peaked at over 10%. So we're definitely not in this area right now where we're recovering. Our economists feel we're in the middle to mature stages of economic expansion. And so we have moderate GDP growth, which is about 3%. We have slow return to inflation. There really hasn't been any inflation to speak of, except in a couple areas of consumer goods. We have the Fed, pretty normal policy for the Fed. They haven't had to take much action recently. Interest rates have not started to rise yet. Eventually they will. Steep but flattening yield curve, double-digit return on stocks, and then heightened volatility. So we haven't seen the rising interest rates yet, and we haven't seen heightened volatility on equities yet. So we think we're more kind of in the earlier stages of maturity right now, which is good. Eventually, as the economy goes through cycles, then eventually we get into a slowing economy. We have inflation. Federal Reserve starts to raise interest rates, profit slump with corporations, and that's where we want to be a little bit more cautious with our investment portfolios. So big picture, we're in a good stage right now for growing our portfolios. And I always tell investors the worst 2 enemies of what you're doing are the weatherman and yourself, right? So the weatherman is like, oh, it's going to rain really hard tomorrow and it's sunny out tomorrow. And then, we might get too much snow this winter, or we might, whatever it is. And the weatherman to you is who? The news media. The news media kind of constant barrage of, PE is too high. Federal Reserve is going to raise interest rates tomorrow. And my brother-in-law read a book on how the stock market's going to collapse. And, oh, when did you read that book? Oh, you read it a year and a half ago. That's why we're sitting in cash for the last year and a half as the market goes up 20%. So, George, question?
Yeah, two things. I think the Fed's inferred yesterday that the interest would stay flat the way it is through like 2017.
Yeah.
I think was the inference.
Yeah, the Federal Reserve has indicated that they'll likely be keeping rates low through 2016 is what I heard, until 2017.
And the heightened volatility, what drives that?
Heightened volatility, you probably remember a few years back, it could be anything from world economic events. So it seems like our economy is so strong right now, it's kind of shrugging off all the things going on around us. So you have, the Ukraine and Russia, and you have, the Gaza Strip with Israel, you have ISIS, so all these world events. You'd think that the market be, up and down, but investors realize right now, the growth is good, it's there, it's time to, make your portfolio grows. So it could be a number of factors, but rising interest rate environment historically is going to create more volatility for the market because of, just that little uncertainty out there. But otherwise, not much volatility to speak of in the last 12 months here, which is good. Makes my job easy. No phone calls from George. So globally, we're kind of a multi-speed right now. I would say that when you look at the global economy, the areas that are the weakest right now would be Europe. And European stocks are not up at all this year, where our stock market is up anything from 7 to 10%, depends upon the sector. And so the slowdown in Europe, I think, is a little bit due to what's going on in Russia. I think there's a boycott of Russian goods and vice versa, boycott of European goods. Their unemployment rate in Europe is 9%, which is pretty high. And then they don't have the energy and resources that we have here in the United States. So we're on a family vacation over to Italy this past March, and gasoline there is $9 per gallon. So pretty much that's all throughout Europe because they don't have the natural resources, so they have to import. And so when it comes to manufacturing goods, it's less expensive for manufacturers to be here in the United States. And I always give the example of if you build a Volkswagen Passat in Germany, it costs $8,000 more per car to build there than it does here in the United States. Isn't that crazy? So there's been 17 automotive manufacturers that have built and expanded here in the United States in the last 3 years because of cheap energy. So just a quick comment on foreign cars that I just found out. If anybody's planning a European trip, if you want to buy a BMW or Volvo, you can actually, BMW has a deal where if you buy the car in Germany, they'll fly you over there, you can drive your car around for a while, and then they'll send it back here to the United States, and it costs $3,000 less, and the trip is free, basically, other than room and board. So if you're looking at buying a foreign car, you might check with your auto dealership. Did you get that with the Corvette Stingray, Denny? Oh. Oh. Where to?
My nephew did that.
To Germany? Yeah, it's a sweet deal. Sounds like a lot of fun. So we're stocks, double-digit growth. As I said once already, the S&P 500 is up about 9% year to date. The mid-cap stocks are up about 8% year to date. Small company stocks are up about 3% year to date. European flat. Emerging market stocks up about 8% year to date. And so overall equity performance has been pretty decent. Bonds, here what we're finding is that there's fewer sectors that offer an attractive return in bonds. And so if you were to put your money into government bonds right now, the interest rate or the yield is down in the area of 2%. If you're using high yield corporate bonds, you're probably getting 6 to 7%. And so what we're suggesting to investors in this area is be diversified. So instead of just putting your money in like treasury bonds or munis or mortgage-backed securities, we say spread out the risk, use strategic income funds that the portfolio fund manager, he can or she can go any place in the world to buy their bonds. They're going to bake them. But so the strategic income funds, their job is, if we have a rising interest rate environment, they're going to do their best to protect your principal. The yields, we're still looking at 4 or 5% on strategic income funds. Rates of growth on this type of fund year to date are probably 7%. So we've seen some nice, upside potential in there, but probably flattening out. This slide here talks about the different types of stocks, and you do have this in your handouts, that we're sowing seeds, we believe are in full bloom, and it's harvest time. So early this year, I had talked about cyclical stocks, and cyclical stocks have been a very good investment recently. So a typical week for me, this week as an example, I had at least 3 clients that came in. Monday morning started off, they came in, they said, we're planning on finishing the basement at our cabin up north. So we're going to need $30,000 out of our portfolio. I had another appointment that somebody came in and they're remodeling their master bathroom. And so they said, we're going to need to earmark about $10,000 for that. I had another client that came in and they said they're selling their home and moving on to something that's more maintenance free. So they needed money on the portfolio for this. People are buying condos. People are, out there spending money, cars, traveling more. I had a couple that came in, they said, our funds have done well and we've been putting off that trip to Alaska for quite a few years now. We need $10,000 out of our portfolio to go on that nice trip that we've been planning all these years. So the types of stocks that benefit most when people feel they have money and are spending money, that would be your cyclical stocks, okay? Another example would be vehicles. So Ford Motor Company, their car sales are up 25% year over year here in the United States. In China, Ford Motor Company sales are up 50%. So you're actually on a waiting list if you want to buy a car in China right now. So again, that's kind of a sign that certain areas of the global economy are doing pretty well. So we like the cyclicals. Defensive stocks might be a company like Walmart. They're the food and beverage manufacturers, utility companies. So investors go to those companies when there's not a lot of growth in the economy and they just want stability and dividends coming in. So that area of the market hasn't been as great of a return. Areas that we're adding to right now would be the emerging market stocks, because typically they go in big cycles. And so like in 2013, they really didn't do anything. This year they're starting to take off, but as the global economy improves, and you can start to see it, with the car sales in China, those are little signs and little sprouts, as we call them. But so we're saying, okay, add to that area. I mean, you're getting in low, and eventually, we think it'll go up. Okay. Any questions on any of this?
Example of the sowing seed. Do some examples of some stocks in there.
Examples of stocks where we're sowing seeds. Most of the monies that we recommend be invested, we use mutual funds. And so in mutual fund terms, I would say that small cap stocks haven't performed as well as large caps this year, and then also the emerging market type stocks. Okay. All right. Let's go ahead and move on here. This one here slide talks about alternatives to the bond market. And of course, as we know, bonds are barely keep pace with inflation. So as investors, you can say, okay, well, what else is out there? That doesn't raise my degree of risk as much, but gives me a better yield. Some of the areas that we like right now are the REITs, real estate investment trusts or partnerships, and then we also like master limited partnerships. So the REITs, we'll be doing another workshop on that. I think a lot of our investors have on average 10% of REITs, dividends. A lot of the REITs that you have right now are, they bought properties from 2008 through 2013, and a lot of those properties have gone up in value. So many of the REITs are starting to go public right now. So you'll see your REIT company, they'll send you something in the mail saying they're going to have a tender offer, or they've merged, or they're going to list it. And if you get any of those notices, just don't do anything with them until we call you, because sometimes there's other people that try to buy you out of your shares, and you don't want that to happen. So you'll get a lot of mail from these REIT companies. This area here, master limited partnerships, we started recommending this earlier this year, and the main area we talk about is oil and natural gas pipelines. And what we like about that sector is that it's a most efficient way to transport oil and natural gas is through a pipeline. And so there's dozens of new pipelines being built across the country. You cannot legally own a pipeline unless you're a US citizen. So that's why they put them in the format of a MLP, Master Limited Partnership. But when you own the pipeline, how you're getting paid is they push volume through the pipe, and it's a set contract between the drillers and the refineries. And so we already know what the cash flow is. And I'll just say typically it's about 6.5%. And a lot of that comes back to you without any income tax on it. So it's pretty consistent farming. That's your dividend that just keeps coming in just like clockwork. And then plus you get the growth of the asset class because of the demand. So we've seen some nice growth numbers in that sector also. Okay, Gary.
Getting back to the REITs, there's been some articles on it's not a good time to be getting in there. You should be leery of it.
Yeah, the question is on REITs, not a good time to get in. You should be leery of it. And those are the same articles that people need something to talk about, something to write about, some opinion on something. But I think it really depends on the sector. So there's certain sectors of REITs that we say are pretty fully valued, and the ROR on it, you just can't get a good return anymore because the prices of certain commercial buildings are up too much right now for investors to get good yield and dividends. But then there's other sectors we still feel pretty strongly about. And what we try to do in the REIT world is we do our due diligence. If I offer one of my clients a REIT, it actually goes through quite a bit of compliance before it can even become on the LPL platform. And so the REIT companies that we're using, have 30 years experience, and so we're relying on them to be buying right, making sure they have good cash flow. And so I think it depends. I had a referral in, not too long ago, and I was talking about, different investments and alternatives, and I mentioned the word REIT, and he said, I don't want anything to do with that, because I had a REIT and I lost everything. And it wasn't, that was a couple years ago. So he probably had one of the REITs that wasn't as, the due diligence wasn't done, or as, who knows. But I think they're still a pretty good asset class, especially when you can get 6.5% and we know it's pure cash flow. Yeah. And we got to remember too, the other part about REIT investing is the population of the United States is growing by 1%. And so we have 310 million people here. So we add 3.1 million people to the U.S. every year. So it's urban growth, urban expansion. And so, again, you need new buildings, you need new housing projects. I heard that the kind of the biggest slowdown in housing projects right now is lack of skilled workers. They said a lot of people left the industry in 2008, because they lost their jobs. And then they said a lot of the younger, I'll just say younger men, not to be stereotypical, but they're out in the oil fields. If they want to make money, they'd rather go out to the Bakken Range, or a lot of people down in Texas are working in the oil fields out there. And so there's a lack of labor. Has anybody done any home projects, construction projects recently and found that it's kind of hard to find people to come over and get stuff done? Yeah. It's just taking a little bit longer cycle. And that's a good, it's a good place as far as investing. You'll see a lot of your mutual funds are investing in companies like Home Depot and Lowe's and Menards and Honeywell and home suppliers. Ford F-150 pickup trucks. If people are gainfully employed, making a lot of money in the construction industry, Ford F-150 pickup trucks, that's the #1 selling vehicle in the world. So, and there's a lot of them selling right now. These are some of the other signs that, that you can see, and you'll notice that if the harvest time does come, and I won't bore you to death with all of them, I can just talk about one of them, and that's the PE ratio. And so we have LPL Corporate. It's not just my office here. LPL Corporation actually has 14,000 advisors nationwide. They have 3,000 employees in Boston, San Diego, and North Carolina. And they have 3 full-time economists that study these numbers. And so, again, we're trying to sort through all this so we can help our investors make the best decision. But oftentimes you hear this thing called PE, price to earnings ratio, and news analysts or Yahoo Finance says, oh, PEs are way too high, time to get out of stocks. But when you look back in history at different periods, so from 1949 to 1965, PE ratios got up to 17.8 before there was a correction in the market. 1970 to 72, PEs were up to 18. 82 to 87, 17.6. 1990 to 2000, that was a good run in the market. PEs actually got up to 28.2. Just couldn't get enough of those stocks. And then 2003 to 2007, 16.8. Right now, the current PE is 16.7. So based on historical standards and what other investments are out there that people could put their money into, we don't feel PEs are too high at this point. When they start to get up to probably the 18 range, then that might be time that we're going, okay, yeah, maybe we should scale back on these equities. So other than the short-term market hiccups, I think we're in a good position to keep growing. These are some of the super themes. Waves of innovation, what new inventions are likely to impact companies. And so we're going to, when we have our disruption in motion workshop, we're going to talk about everything from 3D printing. You guys have read and heard about that. It's just crazy technology. We'll talk about the Apple products coming out, what it means to you as investors, how this world changes. Current consumer currents, what are consumers likely to increasingly spend their money on? There was a book years ago called Beating the Street by Peter Lynch. Everybody remember Peter Lynch, Fidelity Mutual Fund manager? And he actually he actually had groups of school-age children that could beat the stock market because the school-age children could see where their spending trends are. So they buy Nike and Topps baseball cards and Walt Disney and things that they knew. So the good investments oftentimes they're just right in front of our face, and I can see where people are spending money right now, and that's those cyclical stocks are trending quite well. So you don't necessarily have to do this as an investor, but your mutual funds, when you get those annual reports, you can look in there and you can say, okay, well, how are they? What kind of stocks do they have? What sectors are they most weighted towards? And they're taking care of this for you. Okay. So by the way, they have this thing called electronic prospectus delivery receipt. So if anybody wants their prospectuses electronically delivered, it'll save you a lot of mail in the mailbox. Just ask Scott about that. Global policy and income climate change. What impact will changes in global policy have on market and economies? And that's always a wild card for us. And you've seen that for decades. There's always things going on that, the unknown out there. But again, What we have to do as investors is we have things like crop protection. You might have annuities in your portfolio where they grow, but they have a guarantee. You might have all-weather type funds that have a mixture of stocks and bonds, and they're more conservatively managed. You might have REITs. You might have some funds that have gold in them. So there's different ways that you can hedge against these major policy and income changes. And then I'll wrap it up with my last slide here. Just hang around. So this is a super theme. U.S. farmers have become massively more efficient. So you can see in 1924, corn yield bushels per acre, 22 bushels per acre. Look at it today, 165 bushels per acre. Think about, a lot of you probably have a house on a 1 acre lot. And can you imagine 165 bushels of corn off of that 1 acre of property? That's amazing. And then soybean yield bushels per acre went from 11 to 43. You'll see the milk production, thousands of pounds per head is 4,000 pounds per cow per year. Now it's 22. Good hormones in the milk these days, right? And then wheat yield bushels per acre, so 16, now it's 47. Is that amazing? So that's why it doesn't take so many people working on the farm these days. So interesting stuff, fun to see. And then this is another super theme, skyrocketing petroleum and the rail traffic. And again, as you come in to do reviews, I'll be talking about this stuff with you about, using, adding some in your portfolio to these income producing funds and, capitalizing on the return. Okay? So with that, I'm going to just wrap up and say, once again, thank you for your business. Thank you for coming to our workshops. Really appreciate having you here. We're trying to keep the ideas fresh and new so we can keep you coming. So if you have any ideas for us, please let us know. And again, if you have any friends, family that might enjoy coming to lunch with you, please invite them.